ever since Powell let the cat out of the bag and basically conceded that rates are coming down, and they're coming down substantially, the markets, got ahead of it. And in fact, I think the mood on Wall Street was, happy days are here again. We're going back to zero. We're going back to QE, because that is the experience of the past. I mean, once the Fed starts cutting, they don't stop until they get to zero. I mean, that's what they've done in the past, right? And so why would anybody assume that the future is going to be any different?
Philadelphia Federal Reserve President Patrick Harker has expressed opposition to further interest rate hikes by the U.S. Central Bank, indicating a potential willingness to reduce short-term borrowing costs in the future, though not immediately. Harker stressed the importance of a gradual approach to moving rates down, emphasizing that it doesn't have to be done hastily and won't happen immediately. Stockbroker Peter Schiff, noting historical trends, points out that once the Federal Reserve begins cutting rates, they typically continue until reaching near-zero levels. Schiff suggests that this pattern makes it reasonable for market participants to anticipate a similar trajectory in the future. The latest summary of economic projections from the Federal Reserve reveals that 2 out of 19 officials predicted at least one interest rate cut in the coming year, while the majority foresees 3 rate cuts in 2024. One Fed official is projecting 5 cuts. Schiff also highlights the potential for a return to quantitative easing, especially during an election year. He draws attention to the Fed's previous actions during the COVID-19 pandemic, where they significantly increased holdings, representing 56% of Treasury securities issuance through the first quarter of 2021. While the Federal Reserve can impact the money supply, Schiff notes that the Treasury Department holds the authority to create new money and implement fiscal policies, including taxes, to inject funds into the economy. The effectiveness of quantitative easing remains a subject of debate among economists. Despite the debate, many believe that the Federal Reserve's QE program played a crucial role in rescuing the U.S. and global economy after the 2007 to 2008 financial crisis. Quantifying its results remains a challenging task. Explore the valuable insights presented by Peter Schiff in our videos, and for the latest updates, subscribe to our channel and turn on notifications.
In fact, considering how quickly Powell capitulated on rate cuts, because as I pointed out in an earlier podcast, in the November meeting, Powell said, we're not even thinking about rate cuts. And then in the December meeting, not only are they thinking about it, but they're plotting it on these dot plots. And that's all he talked about is cutting rates. So in one meeting, it was a complete pivot on rate cuts. Why shouldn't the markets expect that a similar pivot is coming with respect to quantitative easing? I mean, that's, the big enchilada that's coming is a return to QE. And why wouldn't they do that? They returned to QE before. Remember, when the Fed's balance sheet was like $4 trillion, they started shrinking it. They never even made it down to $3 trillion, and then they blew it up to $9 trillion. And so, so now they started to shrink it. All right, it's below $8 trillion. But if they couldn't shrink the smaller balance sheet, it's even less likely that they can shrink this even larger balance sheet, especially in an election year. The odds would seem to favor that going into an election year, especially, when Biden is as unpopular as he is, right? So he's going to need a lot of help to get reelected. And the Fed typically can be counted on to supply that help. And so the markets are getting in front of this. Obviously, it's an election year. They want to put a lipstick on the pig of an economy, that is Bidenomics. What can the Fed do? Well, let's start cutting rates. Let's go back to quantitative easing. Let's goose the markets. Let's get people excited and let them believe that the economy is getting better. And maybe they think, who cares about these inflation numbers, because we just got to make it through the election. Maybe the result of us returning to quantitative easing and cutting rates, maybe the impact that has on prices won't manifest itself until after the November elections, and then it's too late, right? You can't take your vote back, right? If you actually get fooled into believing we have a good economy and you vote, 4 more years for Biden, And then after the election, you find out the truth, right? All of a sudden, prices take off and it hits the fan. You can't get your vote back. I mean, it's a final buy, right? There's no returns, right? You vote and you're stuck with who you voted for. So all they have to do is delay the consequences until after this election. So the markets know this, they think this, and so they're buying. But then, you've got all these Fed guys coming out and saying, maybe we're not going to cut. We're not so sure, right? We got to wait and see. We actually need more data. We're not really talking about rate cuts. And since that's the only thing that the market's got going for it, it's all about liquidity. It's all about inflation. That's the story. It's an expensive market, and the economy is weak. But that's the hope that the markets have been bid up on. And so I think finally we've started to see some surrender. So unless the Fed wants to come to the rescue of the market, by now reversing those calls, which it might do if the markets fall enough, right? We could see some significant downside in the markets, given how big this run has been, and how the only thing that's propped it up.
Peter Schiff suggests that the recent resistance from the Federal Reserve has likely prevented gold prices from surging to new highs and has helped in mitigating a more significant decline in the US dollar. The DXY index, measuring the US dollar, displayed signs of weakness on Tuesday, with a modest decrease of approximately 0.35% to 102.13%. This dip is attributed to the continued pullback in Treasury yields, a trend that followed the Federal Reserve's recent pivot, announced the previous Wednesday. In the Wednesday trading session, the gold spot price showed a noticeable downward trend, currently hovering around $230. Buyers are adopting a cautious approach, stepping back to consolidate gains, especially considering that the gold price is at levels not witnessed since May. Peter Schiff's observation emphasizes the delicate balance that the Federal Reserve must maintain. Schiff argues that the potential for a weaker US dollar could pose a challenge to the Fed's ability to implement rate cuts, as indicated by the DXY index. A weakened dollar has the potential to worsen the decline of the dollar, complicating the central bank's monetary policy decisions. This underscores the intricate considerations the Federal Reserve must navigate in its efforts to manage both gold prices and the stability of the US dollar. Now, let's return to the interview.
I mean, that's the same thing that the Fed is going to do. They're going to back off. I mean, I think they're going back to QE as early as the fourth quarter of next year, because that's when their bailout expires that they did in March of this year. It's March of next year. And that's when all these banks are supposedly going to repay the loans and take all that underwater collateral back on their balance sheets. Well, there's no way they're going to do that. Well, the Fed is going to have to do QE in order to relieve them of that burden. And so if the Bank of Japan is, doing a 180, and it didn't take them long, it was like a week, and they've all of a sudden, reversed. It's like they tested the waters. They set out a trial balloon, and it got shot down, right? And so, okay, I guess we can't hike rates. We got to stay at negative. And we'll see. Maybe the Fed did the same thing by sending out these minions to kind of push back on the narrative that happy days are here again, and we're going to start cutting rates. And maybe it's going to be a lead balloon if the markets really start to fall, because they were going up, and had the Fed not pushed back, I think gold would already be at new highs. I mean, that might have been one of the motivating factors of the damage control, was to keep the price of gold from really breaking out and to keep the dollar from really breaking down, because a big breakdown in the dollar would really undercut the ability of the Fed to cut rates, because that would exacerbate the dollar's decline. And a weak dollar is going to be pushing up oil prices. And, we also got some other bad news. Maybe this is weighing on the market too, with respect to what's happening in the Middle East, and the fact that there's, some problems going on that has resulted in ships that were sending cargo through that area, and now they're diverting the cargo down below Africa, on the Horn of Africa, and now you have a much longer trade route in order to ship goods. And that is going to increase the cost of shipping those goods and increase the amount of fuel that is going to be required to complete the journeys, because the ships have a much longer way to travel. So not only does that mean it's going to take longer for the cargo to get to its destination, but it's going to be more expensive to get it there, and it's going to increase the demand for fuel because the ships now have a further distance to travel. And so this is also going to be, pushing up energy prices. We've seen a pretty big move up in the last few days in crude oil prices. In fact, oil prices that were below $70 a barrel are now back at around $74. I think Brent crude got back above 80 today. There was a bit of a decline late in the day, with oil was positive about $1 earlier in the day and then sold off. So I think it was above $75 a barrel before we got, the big sell-off where kind of everything got caught up.
The effectiveness of the Federal Reserve's recent resistance to rate cut expectations in maintaining the current trajectory of the US dollar remains uncertain. External factors, such as ongoing fluctuations in gold prices, could potentially contribute to a more pronounced decline. The question arises, are buyers temporarily stepping back to consolidate gains, or does this signify a more enduring shift in market sentiment? It's crucial to consider the delicate balance the Federal Reserve must strike to manage both the stability of the US dollar and the performance of gold prices. The interplay of these factors and how external elements may influence them is a key aspect to monitor. Your thoughts on this matter are valuable. Feel free to share your insights in the comment section. If you found the video informative, subscribing to our channel and activating notifications will keep you updated on the latest discussions. Your participation is highly appreciated. Thank you.